All right. Good morning. Good morning. Good morning. We had a good weekend. How are you guys? I have to admit, I had a little stressful weekend. We put on our iron condor, our wild eye iron condor, our wild condor. It wasn't a condor. It was a wild eye iron butterfly. Put that on Friday, and Bruce and I had a conversation in the comments, wondering whether we should leave that thing on over the weekend or not. Because of the time decay. And we buy those wings, and generally I said, no, don't buy them over the weekend because you don't want to have that over the weekend time decay. But I left it on over the weekend, and I'm going to show you what happened. So I went in and did the demo account. We did the demo account last Friday, and then as soon as the class was over, I went and put it in on my real money account. And so I've got those screenshots for you. I'm going to show you what happened. I have to apologize. I didn't track I was so interested in watching my real money account. I didn't come circle back around and take pictures of the demo account to show how it turned out. But I think it's better to see the real money account than it is the demo account anyway, isn't it? So we will go and I'll show you the screen captures of how that turned out. So we can then go in and enter that in on our spreadsheet. So we'll see. We'll see. All right. But let's watch the morning bell here just a second. I think this thing's going to ring here in about 30 seconds. So I need to go. Let's kill all this stuff. This was all the stuff I had in here for oh, look, the market's taken off today on that rebound, on that pullback. I thought we might get a little bit better pullback. We talked about that last week, this S&P. I thought we might get a little bit of that market is pulling back today. That S&P might come back down to our Fibonacci bow tie. That's what I'm looking for it to do. It'd be nice if it would. I'd like to see it back down in this region here. I know people don't like to see the markets fall, but they got to fall some point so you can add more in, right? You don't want these markets just to keep going to the moon. We got this AI revolution going on right now, and we need an opportunity to get into it. So it'd be nice if it pulled back a little bit down into this region, circle back around, and then turn and take off and go for that third drive. That's what I'm looking for. We may not get it, but we'll see. That was I'm going to save that. There's that. Yeah, I'm going to save that one. So let's kill this one, and we'll kill this one because that was last Friday. That's what we did. And I don't need this one. We talked about the Russell, and we want to bring all those on screen. There we go. All right, look at that Russell. Look at that thing, baby, rock and roll. We're going to do a little scalping, a little day trading. Then I'm going to talk about the wild eye, crazy eye, iron butterfly. And we're going to see if it's an opportune day to put that on. There's no news today to speak of. We're going to pull that up and take a look here in a second, too. There's the NASDAQ getting ready to take off. Breaking above that 100 period moving average, headed for the 200. Getting a little pullback here on the Russell on the open, but the pre-market on that was pretty wild. Look at that. The Dow is the one that's been, I don't need all this stuff on the Dow. Let's turn some of this off. I want to leave the bulls and bears on, but I'm going to turn off the blue light system. Let's see. How do I get in there? Preferences, bulls and bears. Let's turn these lights off for now. We'll just use the yellow dots. Oh, look at it flush after the morning bell. Okay, it's coming down. There's the VWAP. It's touching the VWAP right now. Let's bring this thing up a little bit so you can see a little better. Boop, there we go. All right, so let's see if there's not an opportunity for us to get in and make a little bit of money on the day trading here this morning. And then I'll go show you how the wild eye iron butterfly turned out. Watch these markets. Look how nice and smooth that Dow is. Kind of up through the Fibonacci sweet spot, bouncing off all these moving averages. Let's see what it does. Looks like it wants to flush again. It's going to get rallies. It's going to break through. Could put an order on right there if I was fast enough, but I wasn't fast enough to catch that second rise. We'll see if it holds, though. I think I'm more likely going to fall. Oh, I'm not fast enough for that one either. Quick, get out before it screws up. I try to get in on that short position right there, but looking for that continuation of the downtrend. So we go A, B, C, and see if it's not going to continue to slide. Not the most positive position anyway, with the NASDAQ rallying like it is. We're in the neutral zone. You can see the bars are all yellow. I've got the bulls and bears turned on, which turns the price bars red, yellow, and green. And of course, we're also using Heikin-Ashi. So we're using Heikin-Ashi bulls and bears on a range bar chart. That's pretty crazy. That's a pretty crazy setup. Hopefully you guys had a good weekend. Hopefully your wild eye, crazy eye, iron butterflies all paid off for you. So be interesting to go take a look at that with you and show you what happened. Look at these things. NASDAQ's going to the moon. There was our little buy signal right there. What was I looking at? I was up there looking at the Dow when that happened. Look at that little perfect little setup right there. And up that thing went. How much money would that have been? Would it go from here to here? That'd have been, holy smokeroonies. That's a big market. That's $400 on a $1,000 investment. Whoa, that baby's rocking. That's on fire. Those are big bars. Range bar 20s. Okay, let's see what's going on here. Oh, we're bouncing off the VWAP. I got to get these bars just a little bit bigger here. Which one are we going to trade? Well, I'm trading all of them right now. Yeah, that's a little too big. Okay. Come on, there's an opportunity in here somewhere for us. There's Russell getting ready to rally again. Did you miss the Russell land? You want to take that Russell shot? I think so. We missed it, though. Should we do a scalping trail on the Russell? Come on, Russell. I didn't get into you for you to stop me out, you rotten little bugger. Stop me out. Now it's going to go without us right there. Watch that. Oh, you little snot. Okay, we'll take a scalp on here. And then we'll do a trail. See if it won't rally for us. Okay, we're long the Russell. Come on, scalp that one. Grab that little blue one right there. Come on, buy the bait. Okay, we got our $50 back. Now we got to trail that thing up, see how high that wants to go. Oh, what was that? Jump. Okay, here we go. Rock and roll, Russell. Comes up and touches those highs. We have to question whether we should take that off or not. Got the trailing stop, come to break even. I'm going to change that over and just go to ATR. And now that's running up on the ATR. I only got one contract in. We had two, but we scalped one out. So that's a scalp and trail. Scalp and trail. Let her rock and roll. How much we up? Right there. It says right there, $85. Plus we got our $50 back on the first one. So we're back to $5. Plus we have to take commissions and fees out. So we're right scratch trade right now. Well, we're making money now because it's moving in our favor. Notice that the trailing stop moves all by itself. Just trails up behind there. If it hits that blue limit up there, that'll just take our profits right at the previous highs. This is our resistance zone up here. Right about right there. Is he going to make it up there? Not without a pullback. There it goes. Stopped us out. So we're up, that made us $80. $80 on that scalp and trail. That's not bad wages. $80 in 5 minutes. Probably wasn't even a full 5 minutes. Most guys will work all day long for $80. All right. Don't have to go crazy. You're making that kind of money. You can be careful. Right? But Len, I want to make $2,000, $5,000, $15,000 a day like that guy on that other channel. We'll go watch him then. See how he does it. Those guys make $100,000 a day. It just says so right there on their thumbnail. All right, go watch them then. Okay, here we go for another break. It's probably going to go up, and I missed it. I missed that one. It's pontificating. Think it's going to go? Do you think it's going to go up? I do. Let's stick it in there. A little late to the party, but we'll see if it'll break. The break above the previous high. There it goes. Breaking above the previous high. Trying to get up into that scalp zone. If we can get up in there, test those highs, we can take that profit off right there. There it goes. Oh, ticket. All right. We're up $150. That's pretty good wages right there. How many of you used to work for $150 an hour? How many of you ever worked for $150 an hour now? All right. You made your $150 today. You can go back to work now. You can go down, cook some eggs, go to work for $150 for the rest of the day. That's a lot of money, $150. People want bigger money. Oh, I got to have $1,000 a day. If I don't make $1,000 a day sitting here in 1 minute, then I'm not doing this. This ain't worth it. Okay, well, go do your engineering job. Go do your doctoring job. Go be your accountant. Then do whatever you want. I don't care. It's just what I like to do. No, look at it, breaking above, breaking higher. Wow, look at that going. You got Outland. Yeah, well, that just means there's lots more opportunities in here. You could have gone in with 15 contracts. You'd be up 1,500. Yes, that's true. But if I would have got in and lost on 15 contracts, look how far down I'd be. It's all relative. It's all relative. Look at this market go. That's beautiful. Those little yellow dots. Just cross the yellow dots. Just trade the yellow dots, land. Just trade the arrows. That's why you're here to watch. You go do that. Look, you want to do what I'm doing here? And you can do it better than I can. I know you can. You can do it better than I can. Go do it. Go do it better than I'm doing it. I'll give you the setups. I'll show you how the software works. I'll show you all the settings I'm using, and then you can trade it yourself. How about that? Is that a good idea? You can out trade me. Look, all you need to do is go get the software. Here's the software I'm using right here. It's called Track and Trade Live. It hooks up to the futures market, not to the stock market. And that's where we get the leverage over there on the futures market. It's called a hedging market. It's designed for hedging the stocks that you own. All right. So that's why it's there. But we're not hedging. We're just going to use it for speculation. We're going to use it as day traders. So you go over there and get this software. You just go to trackandtrade.com right there. It's a really good software. It's won Stocks and Commodities Annual Reader's Choice Award 6 times. It's actually won it 7 times. I just haven't updated the graphic. And grab that software. Come over here. And then here, I'll give you the settings that I have. Here they are. So these are range bars. Let's pull this one up full screen. All right. So these are range bars. And the way you turn those on is you come into your charts like this. And you see down here, you got little tabs. And it comes with a range bar 4. I like range bar 6. You can do range bar 4. I mean, the default settings. These are all customizable. So you right-click on that little tab down there. Right-click on it. And it'll pop up this little window right here. And you can choose what you want those tabs to be, what you want your charts to be. And right in here, change the 4 from the default that comes in the software to a 6. I like 6. That's what this is. This is 6. All right. So if you go over to my website, tradementors.com, there's a free course you can get over there called, what's it called? The Heisenberg Strategy. And it talks about range bars. And then Heisenberg Strategy is all about range bars. All right. So range bar 6 is my favorite. It's the one that seems to work best for me. Doesn't mean you can't use 4, 5, 6, 7, 8, 9, 10. You certainly can use anything you want. On the NASDAQ, I use a range bar 20. All right. So that's how you get your range bars pulled up. And then you can open up your chart over here. And the one I'm looking at, this is just the Russell. So this is the Russell. You just slide down this list. You find Russell in here. It's right there. The one I'm using is mini. Now you can use the micro mini if you want to. It's 10 times smaller. So if you're a little bit nervous in the beginning, use the smaller one. All right. The software gives you a demo account. You practice in your demo account until you feel comfortable doing it. And then you just go over and do it in the real money account. It's the exact same thing. You just how you open up the software, whether you open it up in demo or whether you open it up in real. It looks exactly the same. There's no change. In fact, you can even use the same chart, the same file and everything. It doesn't know the difference. Software doesn't know the difference. It just knows it's a different account. All right. So then you open up the micro minis, 10 times smaller, or you can use the mini. You don't want to use the full size. I've got that turned off. It's for the institutional size traders. That's way too big for us. All right. So we just use the mini and the micro mini. So this is the mini. And here, if you turn on portfolios, you can have them set up in portfolios so that you can then just have them all listed for you. All right. So for example, I've got the mini Russell right here. If I click on that, it just brings up the range bar. I got that set to range bar 10 right now in this one. Range bar 10, 1 minute, 5 minute, 15-minute chart. You can see I can put all four of them on the screen at once, just like that. And then I can trade the one I want. I can trade up here. I got the range bar 10. We can come down here again. If I want to change that back to range bar 6, I just bring it full screen, right click on the tab right there, make that range bar 6, just like that. Apply. And then it makes it range bar 6. And it kind of screwed up those bars right there. You can fix those if you want to. I don't usually bother with it, but it kind of screwed them up between range bar 6 and 10. So those are not real bars. You just come in here, you go manage local cache like that. You kill them. Yeah, I just delete them all. I don't bother trying to find the individual ones. I just delete them all and then hit OK. It'll restart the software, and then those little bars will be gone. So if that bothers you, you can get rid of them, but it doesn't bother me right now. I don't really care. Maybe we'll let it go. We'll see. That's switching. Sometimes when you switch from a range bar 6 to range bar 10, I noticed that it kind of screws up a few bars, but then it starts working again like that. It's no problem. All right. So that's a little thing that happens when you're switching from one time frame to the other. I showed you how to fix it if you want to. Otherwise, it just pushes off the screen here in a minute and it'll be gone. So there you go. Now, those are not candlesticks. If you want candlesticks back on, you right click on the chart, say price bar types, and you say candlesticks. Say candles right there. Boom, we're back to candles. All right. Now, also, I use the Heikin-Ashi bars. Now, you notice I've got Heikin-Ashi. It's right here. You can turn them on. That's without Heikin-Ashi. I like Heikin-Ashi. So I click the little button and it turns on Heikin-Ashi. Now, your software, when it comes out of the box, might not have HA on your price bar up there. So what you do is you right click on here. You right click on the little tool handle. See that little handle up there? It's got a little handle right out there on those toolbars. You can grab that little handle and move the toolbar off if you want. That's what that handle's for. In case you like to put it somewhere else, you might be able to, if you want, I think you can attach it to other places. I just like it right up there. But if you right click on that little handle, you can customize your toolbar. And in your customize list, you come down here and you slide down until you find HA. Now I've already got HA moved over. So you find the one you want and you hit add and it puts it over here and then it adds it into your list. All right. Now I don't need to do it right now, but that's how you do it. And then it brings up HA on your little button bar up there. And now you can just turn HA on and off. So whichever chart you have open, it's going to change HA. If you want them all to change, see how they all change at the same time? Well, I only want this one to change. Okay, we'll bring it full screen. And then you're only changing that one. Now you can come back. Now these are all still HA and that one's not because I changed it full screen. Bring it full screen. I can make that one HA and then I can not. Okay, so there you go. And then I use the ATR. I like the ATR. The ATR is just called the average true range. That's all it is. Stands for average true range. So it tells you the average true range. So when a market flips from one side of the average true range to the other, that's usually a good place to get into the market, go in one direction or the other. So this is your average true range settings. Over here, I got ATR period. I like to just set it to ATR period 1 because we're scalping, we're day trading, we're taking some very short-term trades. So that's what I like to do. And then stop factor, that's just your little yellow dots. How close do you want to trail behind the market on your little yellow dots? Well, you can make them trail farther away, or you can make them trail closer. Oh, let's do this one. Make them trail farther away. See that? How far do you want to hold your stop back behind the market? And then you put them a little closer. Sometimes you want them really tight, right? You can go right up in there, right up and tight like that. So I usually like to have them around, I just like to have them trail up behind the market, nice and smooth. So you can have it like that. If you get them too sometimes in the market will come down, stop you out, and continue on. So it's kind of a game you have to play between being. It depends on the market, how aggressive the market's being. The more aggressive the market's being, the more aggressive you can be with your trailing stops. Right, a little bit less aggressive, the market's being a little bit lazy, comes back and stops you out too often. Well, loosen that up. So loosen it up so your little dots aren't quite so close. Somewhere around 1 to 1 is a good place to start, but you can see right now today's market that's a little bit far back. So I can make these dots a little bigger too, like that. And then you can make them a little tighter, bring it up a little tighter like that. And then that gives you a little flip over right there. It looks good right there. And that's telling you, hey, let's go long again, Lan. So you can come in and say, okay, I'm going to buy the market. So we're going to go up. I'm a little bit late to the party. I like to generally get in on the dots when it crosses the dots. And I could do that with these tools down here, but you get the idea. I can show you those. And then as the market rises on that arrow, you make money. If it doesn't rise, you get right back out. The whole name of the game is cut your losers short and let your winners run. If it goes, let it go. If it comes back, get out fast. So you have a little tiny loss. You don't want to take big losses. And then if you're like, hey, I've made enough money, well, you can bring a stop order in there, drop it up in there and protect yourself. And then you can say, hey, I want that stop order. Hit edit. I want to trail that stop on that little yellow dot, which is the ATR. You hit OK. And it'll just move up on that little yellow dot all automatically for you, right to the settings you put it at. And then it'll trail up until it comes, market turns around, comes down and stops you out. And that's it. That's all there is to day trading. You just have to learn how to do it. You just have to have the right tools. Makes it easy for you. Now, trading's not easy because there's emotions involved. But when you're doing it in the demo account, there's no emotion because you're trading with somebody else's money. But when you trading your own money, then it gets a little bit scarier, and that's kind of where people screw up. They get a little bit too nervous trading with their own money, where they're not scared trading with somebody else's money. Excuse me. All right. And then what we do is we look for these little red to greens. Little red to greens are oftentimes good places to get in. So you draw your little trend line in here and you say, well, if it breaks above that, it goes from red to green, I'm going to get in again. Oh, well, that's a good idea. Get in right there. And then it goes from green. As long as it's green, you stay in. That would have been $100 had we stayed in right there, just adding that little bit right there. This market's doing really well. So it's a little bit easier to trade this morning. Sometimes the market just goes sideways. If it does that, then don't trade. Go down, cook some eggs, and go outside and ride your bike or something. Come back later when the market's moving a little bit better. So the whole idea is just only trade when the market's moving good. If it's not moving good, don't trade. But you can make so much money at this thing. Look, we're already up $200. Most people work 8 hours for $200 or less. And we're just trading one contract. We're just being easy, careful here. All right. You want to get in right here? No, probably not. Why not? Well, because it's probably topping out up here. It's already gotten 4, 5, 6, 7 bars in a row. Doesn't mean it can't. Oh, there's a little pullback. So you can get in a little pullback right there. Those are oftentimes good spots to get in. See where it's making lower highs and starting to rally once again? You can get in right there. Let's try it. Let's get in. Well, of course, if we're wrong, we just want to get right back out. So we're going to put our stop on the yellow dot right there. If it turns around, stops us out, we just get out the small loss. We have to give back some of the money we made. But if it goes, we can trail on that ATR. If it goes, we'll make some more money. If it comes back, stops out, we'll have to give back some of the 200 that we made. But you got to take a little bit of a risk to find out if that market's going to make you some money. The risk is just the difference between where you get in and where you get out. And the decision of getting out fast, as soon as you decide, hey, that market's not going in my favor, just get out, because there's no reason to stay in there if it's not going to go in your favor. And it doesn't look like it wants to go right now. It looks like it wants to turn around and come back. I may be wrong, but I could get out right now and not take a loss. But of course, if I get out and it goes, then I'll be mad. But it's not going. So I just got out, took a little haircut right there, because that market didn't go. Now, it might go again. It might take off and go now, but it didn't go when I got in, so I just got out. If it doesn't go, get out. Don't lose much. See, now we're down $190. That costs us $15 to find out if it's going to, oh, hey, it's going to go down. You want to see if it wants to go down? We can see if it wants to go down. Put in our stop. Put it right there on the yellow dot. If it comes back, we'll get out again. Oh, we got out again. Now look, now we're down $150. So when you do that twice, if it goes down, it doesn't go down, and then it turns and goes back up again. That's when I generally stop trading. I'm like, hey, I got lost twice in a row. That's not a good time to be trading anymore. So I'm going to stop and wait for a minute and see what it does. Oh, it's taking off. It's trying to take off. Look, that we just tried to get in too small. So there's a little red to green right there. Now it's taking off again. We should have been a little bit more careful. There it goes. Red to green. Land. I know you can do better than me. Go get your software. Quit complaining that I didn't do it right, and you go do it yourself. Sometimes you don't do it right. Man, look at that market go. It's on fire. Wow. Look at the Russell. Wow. Let's go look at the news. There's no news today. I already looked. No news. Let's pull up the news. Oh, I was wrong. There is news today. Oh, wait, that's out in that's in what country's that? Denmark? We're not interested in Denmark. I was going to say, I thought I looked to see what the news was for the U.S. today. Let's clear all these. We're going to clear this out. I'm going to come down here and just have U.S. Hit save. Impact 2, UTC 6. You're going to have to adjust that to your time frame. Mine's Mountain Time, U.S. Mountain Time 6. So at 1 o'clock today, Fed Waller is going to speak. That's the only thing we got going today. Dallas Fed Manufacturing comes in at 8:30 this morning. Didn't really... I don't know. Maybe that's what's moving the market. Fed Daily speaking today at noon. So we got a couple of Fed guys speaking, but they're not going to change anything. They're just going to pontificate. So we got some pretty good. That's man alive. Are you going to attribute that to the Dallas Fed Manufacturing Index? Forecast was 13. Previous was negative 19. So that's actually bad news. So it's very little impact though. Man, look at this market go. Look at that Russell 15-minute chart. That thing's going straight up. Oh, this is the Russell 15. This is all the Russell. These are just different time frames. This is a 5-minute Russell. That's a 1-minute Russell. So when I say that this is a 1-minute Russell, this is a range bar Russell, this is a 15-minute Russell, and that's a 5-minute Russell. It's all the Russell index. This is a 1-minute, meaning each price bar represents 1-minute time frame. So the open, high, low, close. What does it open at? What is the high? What's the low? What's the close? That's all represented in that one price bar. All right. And then the next one goes over 1 minute later, 1 minute later, 1 minute later. What about the 15? Well, each price bar represents the open, high, low, close for the 15-minute time frame. This is a 5-minute, so you can see each price bar represents the open, high, low, close for the 5-minute. Now that's a range bar chart. There's no time involved in the range bar. It's starting to go sideways a little bit there. So it had that last little push higher that we missed, and now it's going sideways. If you kept trying to get in and out, in and out, in and out, you're going to get beat up right here and give all your money back. So we'll have to wait and see what it's going to do. I'm more interested in seeing it fall at this point. I kind of see it fall back down a little bit. So you could take a short position, but let's wait for it to fall first, and then we'll look for a little pullback, and then we'll look for the next fall. I don't want to. We could try and take the first one and see if it wants to go out, but usually sometimes that fake down it comes back, and it does a few of these, and then you get stopped out and lose all your money trying to get in on the first run. You don't need to catch the first run. Don't worry about it. Wait for it to start to go in the first place. Wait for more people to jump on. Wait for people to decide that that's what they want the market to do. See that? We'd have got in on that little break right there with, oh, let's go short right there. We'd have just got stopped out again. So be careful. Don't try and take the first run. I call them the A1s. Don't take the first runs. Let the market go first, because we get lots of fake and breaks. Lots of fake ones, because they know you're going to jump in on those fake ones. They like to take your money. Remember, we're trading against Wall Street. They know we're out here trying to take their money, so they're going to trick us. This is a tricky, tricky market. They're tricky dickies. All right. They're going to try and trick us. So they want to do these things to try and make the market do things that are going to take our money. But actually, it's us trying to take their money. All right. We're little thieves. We're not working for this. We're stealing it. We're stealing it. Somebody went and was a firefighter, or they were a school teacher, right? That's how this works. Got to admit what we are. We're thieves. They went and worked all day long to save up their savings and put it into the stock market to try and grow their retirement. And what do? We come in here and try and steal it. Try and steal their money. We're not out working for this. We're sitting here trying to steal it. Okay, so as the market starts to run, starts to go up, those school teachers start to make some money so they can retire on it. What do? We come in and try and take their money, steal it. Wall Street doesn't want us to steal their money. So it's a game we play. We try and steal their money. All right. So we say, and is it legal? Yeah, of course it's legal. Of course it's legal. We can legally steal money from Wall Street right through this little piece of software. But it's hard because they don't want you to take it. So they do all kinds of little tricky dicky things to make you not take it. So what we do is we have all these little strategies that we run when we trade. Now I was talking about the open, high, low, close bars. So that's how they look. This is what a candlestick chart looks like. This is called the upper shadow. I call them tails, topping tail, bottoming tail. Okay. So this is your bar. It's called your body. This is your upper shadow. This is the high, the close, the open, and the low. All right. And that's why it's green, because it closed higher than it opened. That's why it's green. This one's red because it opened up here and it closed lower. So it closed lower. Now, during the time frame of that, let's say this was a 5-minute time frame, it went this high and it went this low, but it opened here and it closed here. All right. So that's why it's red, because it closed lower than it opened. So that is a candlestick chart. Now you can change these in track and trade. Make sure you're doing the right ones, because if you're not, your candlesticks might not look like mine. You say, hey, my candlesticks don't look like yours. Well, my candlesticks right now, they're set with the bulls and bears turned on, which turns them red, yellow, and green. And they don't have that color coding of being high close and low close. So that's not how these are working right now. That's only if I turn the bulls and bears off. See, let's see. I don't have bulls and bears on in here. Oh, I do down here. This was bulls and bears. So you can see in here, I got the chart overlay. See, I got bulls and bears turned on. That's all a Fibonacci thing. So for those of you guys who are Fibonacci aficionados, you're going to understand what Fibonacci is. You're going to know that price bars are neutral, bullish, and bearish based on Fibonacci sequences. So that yellow right there indicates that that's a neutral zone right here. It's in the Fibonacci sweet spot between 38.2 and 61.8. That's what that means. All right. So there's another neutral zone. And then if it breaks out to the bottom side, that's why it's red. If it breaks out to the upside, that's why it's green. And it stays green as long as it's above the Fibonacci sweet spot. As soon as it goes through another Fibonacci sequence, it changes it back to yellow. And then if it breaks to the downside, it goes red. If it breaks to the upside, it goes green. So that's what bulls and bears does. All right. But up here, I don't have bulls and bears turned on. Right here, I don't have bulls and bears turned on. Let's look at this 1-minute chart for a second. There's no bulls and bears turned on this one. So all we have is just red and green. So you have to come in here, right click on your chart, come down here to save setting, not save it. Let's see, chart preferences. See that? Chart preferences in track and trade. Now it's a user definable tool. You can make these look like whatever you want. Come down here, price bar colors. See that? Price bar colors. If you're on candlestick charts like I am, you want it to be open to close. See that? You can have it be close to close if you want, from the previous bar's close to the next bar's close, and then it'll change the colors based on that. It's called close to close. All right, that's popular too. A lot of people like to go from close to close. Generally, when we're not using candlesticks, if we go to come down here, price bar types, we go open. Let's see, if we go to open, high, low, close, it's very popular to use this kind of bars when we go close to close. A lot of people like that. All right. Or you can have alternate days, which I don't know what that means. So we're going to come in here to open to close. For us, we're going to use candlesticks, so we want open to close. And that doesn't make a lot of change, but it makes enough. I mean, it's what gives you your candlestick patterns, all right, that you see. So, and I'm going to change them back to candles. There we go. All right. And then we want that to be open to close. And then to save it, you just come up here and say, save as my defaults. Boom. You hit that. Now every chart, and then you say update all charts. Update all charts. Now all charts that are currently open are going to be open to close, and you've saved it as your default. So now any chart that opens up from now on will be open to close. So that's what I like. I like to be open to close. All right. This is a 1-minute chart. Look at it drop. So this is your dropping. We're breaking right there on that indicator. That's called the parabolic SAR. Now in here, those are the green dots are I just changed the color from yellow to green. I don't know why I did that, but it's confusing. Just to confuse you, just to make things a little bit more difficult. What's those green dots, Lan? Well, it's the same thing. I just changed them from yellow to green. No difference. Oh, look at this market fall now. It's flushing. It's flushing down. It's going to probably come all the way back down to that blue line right there. That blue line's called the VWAP. It's called volume weighted average price. It acts like a rubber band, and the market likes to come back down to it. Now, as little thieves, and we're trying to steal money from Wall Street, we have all these little patterns, these little tricks we like to do. All right, so you're going to kind of want to learn a couple of these. My favorite is this one right here. It's just the green bars. Wait for market to move. There's your little yellow, your buy arrow, your ATR arrow, right? So you wait for that market to move, and then when it makes a couple little red bar pullbacks, you're going to anticipate that it's going to continue in that big red trend, that big green trend. If it does, it gives you a couple little red bars like that. You want to buy on a first break of a new high, because we have this saying in this industry: higher highs and higher lows, right? That makes an uptrend. Lower highs and lower lows makes a downtrend. So when the market's in a higher highs and higher low green trend like that, and then it makes these little tiny pullbacks like that, that's just people taking profits from that last move. But then they think the market's going to run and go again. So if it does, we wait for it to break above the previous high to make higher highs again and higher lows. That's where we want to get in right there. That's our buy signal. And then we want to ride it up the next level. All right. We don't try and take the first one, because we don't, we saw a lot of false signals on the first one. And then the market comes back, boom, like that. And then when it starts to rise again, jump in right there. Get in right there. That's a good spot to get in right there. And oftentimes the market will move. If it doesn't, if it just comes right back down, stops you out. Just get out fast. You don't want to take a big loss. But Milan, what if it goes down a little bit and then turns around and comes back up? What if you put your order in and you get in, but then the market turns and falls back down here? Why are you getting out? Why don't you just wait for it to come and turn around and go back up? Well, because it might not turn around and go back up. And these markets you make so much money when you're in, and you lose so much money when you're in. When you're wrong, you lose so much money so fast because there's so much leverage in here. You don't want to lose a lot of money. If you're wrong, just admit it and get out fast with a small loss. All right. So you don't have to recover a big loss. Yeah, it might turn around and come back, but you can't hold on to it that long. Look, there's a little teeny, right there's a little spot right there. See that? Green to red. Now it's trying to go green. You can take that right there. It's being a little weak, so it failed. But we're looking to the downside. We're not really bullish, so we want to look to the downside. Now there's a little red to green right there. We could take that one, so we could just jump in. Oh, I'm late to the party. Look how late I got in. So I'm going to put my order back here. I'm not going to put it all the way back to the yellow dot, because look how much money that is. That's clear back here. That's $70. That would take away a lot of my money. And if it comes back, I just want to get out. I don't want to stay in. So I can bring it a little closer. I bring it down here a little bit and let it sit. If it comes back there and stops me out, I'll get out. Now I'm up $20 right now. I want it to continue to fall. Looks like on the 1 minute chart, it wants to fall a little bit more. Come on, baby. Fall, fall, fall. Doesn't fall. We're just going to get out with a tiny little loss. We give up. Oh, we have to give up some more of our money. Now we're only down to $120. When that happens, that's when I'm like, hey, I'm going to stop trading for now. This market's not doing anything. It's just starting to beat me up. They figured out what I'm doing. That whole Wall Street, they're pretty smart guys. They know I'm in here trying to steal some of their money, and they're just making the market go a little small moves. So they're not letting me make any money. It's not trending anymore. So maybe we need to go look at some other market too. We can come in here and see what else is going on up here. We'll go back. Now that was the Dow that we were looking at. So this is the S&P over here, and it's taken off like a rocket ship too. So here's the Russell down here. Or are we looking at the Dow or the Russell? Can't remember. So now this is the NASDAQ. Now to put those orders in, I have, if you come over here to my little trading tab, I have these buttons right in here. I have these all programmed up so I can go in a lot faster than just hitting buy market, sell market, and I can catch a little bit better trades. And so when I use these automated buttons, I can do a little bit better. There goes the market, taking off without me. So we've lost about $100 trying to get into this market again. We're still up $120. Kirk Kirk says he did the wild eye, crazy eye, iron butterfly trade on Friday. Sweet. What did you do, Kirk? Tell me your setup. I'll go tell you mine. Bruce is coming in at number 1, saying good morning. How you doing, Bruce? Missed you yesterday. I think we missed you yesterday. Weren't you here? You wasn't here yesterday. I noticed. Yeah, I noticed. Michael Bruce. It's good to see you coming in at number 2. We got Kirk Schwartz coming in at number 3. We got Gary Thomas coming in at number 4. We got a whole lot more people up there watching this video than what's putting their little marquees up. If you guys want to say something, go ahead and put your little marquee up there. I'll make you famous. Make you famous in our group anyway. There's Michael Bruce, up $230 today. Kicking ass and taking names. Sweet. Nice, Michael Bruce. Making me look bad. That's what I like to see. I like to see you guys do better than me. That's what I want to see. That's what a teacher, any teacher wants to see, right? They want to see their students do well. Same with you, Kirk. Nice job on the wild eye, crazy eye. Glad to see it doing well. I'm going to pull up mine and show you what I did. See how you did yours. Just watch this market for a second go without me. Look at that Dow taking off and going to the moon. I think we were trading the Russell, weren't we? Look at the Dow, though. Man, that's a sweet Dow. It's going now. It was a little choppy before, wasn't it, through here? Not doing too well, but man, it's taking off now. There's another little tiny pullback right in there. So that's well, I don't know. Look at this. I don't know. Count this with me. Drive 1, drive 2, drive 3. But it could be all just one big drive. Because this is a tiny little time frame. There's 2 drives. Oh man, look at that market. It just kept going drive after drive after drive. We have to go to a longer term time frame to see what drive we're in. But it's making little tiny counter trends in here. So we have to be careful. So little pullback here. Tiny little pullback there. We're getting up. We're going to call that a X2. We're going to call it an X2? I think so. On this little tiny pullback. But what is this? If this is, we're going to call that something A, B, C. Just like that. Little tiny moves like this. So we're going to the C drive. If we break one more high, call this the A drive, the B drive. Or this could be a new A drive after that red bar pullback. All those red bar pullbacks, we could start a new A drive right there. Let's do that. Let's call this a new A drive. So inside that A drive, this would be A1 right here. Sorry. A1. Is that right? This would be A2. That's A3. So if that's A3, this is a B1 right here. Is that B1 going to carry through? I don't know. We're so tie up in this thing. If we go back and look farther, we're not going to be into the ABCs. We're going to be in the EFGs. We need to turn on the bulls and bears and find out where we're really at. So this would be an X. We're just going to call it an X1 right here. Turn on the bulls. Oh, bulls and bears is on. Let's turn on the blue lights and see where we're at in the count. Oh, let's see. Okay, A1, 8. Oh, that started a new drive. So that's got to be technically speaking, that's got to be our B1, right? B1. Because it started with a new set of blue lights. B1, and that right there is a B2. And then this is that was a C1, B3 failure. Is that how that's going to have to be counted? Look at the MACD coming around, rolling off the backside. I want to try and get one more trade in here before we go do the wild eye, crazy eye, iron butterfly. Wild eye, crazy eye, iron butterfly. Here's some more setups we like. Those of you guys who likes to look at setups, here's a setup. That's called I call it decision point trading. Once a market gets to a place where you need to make a decision on whether you're going to get in or not, whether it's going to go up or down, you got all these little patterns in here. Okay. Just kind of flip through some of these and you can see them. Concave, convex patterns. We got counts. We got that one there. We call that the hook, line, and sinker. All right. All these little patterns in here. All these little patterns. See, we've got all kinds of stuff in here to talk about. But most of what we're talking about today are just the patterns. All right. If you want to learn more about this stuff, you can come and subscribe to Pit News Magazine. We feature a lot of these types of trading strategies in Pit News Magazine. You get 3 months for only $1. Try it out. See if you like it. Pit News Magazine. It's our club magazine. It's really awesome because each article, you can listen to it. So we record them so you can listen to them. You can also read them, have all the notes. And oftentimes we'll even include videos if it makes sense. And then if you like it after 3 months, we'll charge you $49.95. You get 12 more issues for $50. That's for a whole year. It's amazing. Come and join us at Pit News Magazine. You're going to love Pit News Magazine. We got the new version coming out. And in that new version, we've got, I think we got 5 versions of the Wild Eye, Crazy Eye, Iron Butterfly in there. So all these different ways of hedging. And that's really what it comes down to is how are you going to hedge your Wild Eye, Crazy Eye, Iron Butterfly? Because the Wild Eye, Crazy Eye, Iron Butterfly is selling a premium on a 0 days till expiration and collecting that premium. And you can collect a lot of money in there. The problem is if the market moves outside your delta cone of profit, you can then start to lose money and give some of it back. So what we want to do is we want to hedge. How are we going to hedge? Well, we can hedge with options. We can hedge with contracts. There's lots of different ways to hedge. We can hedge with theta. In fact, the other day I was watching, we're getting notoriety over here, guys. You should know. I've seen 2 other channels talking about Wild Eye, Crazy Eye, Iron Butterflies. And you all know we made that shit up. We made that name up. You were here when we did it, when I named it. And there's already 2 other websites that I've seen, 2 other YouTube channels talking about the Wild Eye, Crazy Eye, Iron Butterfly. Now, one guy didn't say Wild Eye, Crazy Eye, Iron Butterfly, but he taught the exact same strategy. And he used our terminology, talked about the theta swap and everything. So you know darn well that that's where he got it from. And these are things that most people don't do. You go out there and look on YouTube. This Wild Eye, Crazy Eye stuff with the theta swap stuff that we're doing with the long-term theta stuff, that's unique. There are not very many guys do that. And so to hear other guys now starting to talk about it, we're making a little waves. There's people watching us. There's people paying attention. When little Lan Turner gets on here and says, hey, I used to work at the Chicago Board of Trade and the Chicago Mercantile Exchange, and now I'm a teacher of education, teacher of finance at Utah Tech University, people perk their ears up and they say, what does that guy know that I don't know? You know what I know that you don't know? I know about the theta swap. I know about Wild Eye, Crazy Eye, Iron Butterflies. Why? Because we come to this class and we all work together and we test this stuff, don't we, guys? We get into it. We test it. We do all kinds of testing here. So let's go talk about Kirk's Wild Eye, Crazy Eye, Iron Butterfly. Hey, look at that. Bruce is kicking everybody's heinies. He's up $877 using the scalping trail. Way to go, Bruce. Rock and roll. Let's see. Here's Kirk. Sold the ES at the money, 0 DTEs. bought the 3 days till expiration with 25 points away from the at the money, closed at the end of the trading day. Sweet. How much did you have to give back on your at the money on your you went 25 points away from the at the money. How far was 25 points? How many strikes was that? 25 points. Probably one strike, right? Did you go one strike out? That's what I did. Let me pull up. Let me show you what I did. All right. Here's what we talked about on Friday. Here was the screen capture I did as we did this. Now, if you notice, we did a little bit of a delta skew to the put side. All right, because I thought the market was going to fall. It actually rallied a little bit, but it ended up dead center. I mean, almost perfect. I mean, you could not have picked it better. It landed right dead center of full profit. So that's where that market ended up. It came and landed right on that. See that yellow line right there? It touched that purple line almost right on the money. It was really cool. Worked out perfect. So what you can see is we sold the option premium down here. I know this text is a little bit small and I'm in the way, so I'm going to make it so you can see. There we go. And down here you can see this is the setup. So we bought and we sold. So the sold calls, we sold a call at the money, we sold a call, a put at the money. The cost basis on that was 480 negative, 450 negative, which means they give you that premium. So that was 880, almost $1,000, just a little shy of $1,000 on that premium that we received, right? Kirk saying he was 3 to 4 strikes away. My thesis was that the market will be within the 15-minute opening range. Okay, that's a good thesis. We like that idea too. All right. So we generally, when we're day trading, we'll draw that opening range too within the first 10, 15 minutes, won't we? I haven't been doing that very often lately, but that's a good point that you bring up, Kirk. So let's go back and look at Kirk's idea. He kind of reminded us that that's a good thing to look at. So if we come and look at the 15-minute, the market's going crazy today. I don't know how excited I am to put on a wild eye, crazy eye iron butterfly, but we might. We'll see how it tames down. But the first 15 minutes, you're just going to draw a little channel. Remember, we used to do that a lot, and I've not been doing it so much lately. Kind of got away from doing it. But Kirk's right. We need to mark out what that high and low is for the first 15 minutes. Now, this is the first hour because it's been going for an hour now because this market just went like ballistic. So that's our first hour. The first 15 minutes, Kirk, today, kind of nasty. So 5, 10, 15 is probably right in here. This range right here, which still could be valid for our wild eye, crazy eye, right? If you're looking at this channel. Now, what I like to do is I like to use, so that's the opening range right in there. I'd say that's the opening range for the first 15 minutes. But sometimes what I like to do is I like to use this other tool. I like to use this tool here. It's called the RAF. So the RAF kind of does the same thing, but if we go back to the beginning, let's just go from this peak right in here and out to this low right here. We can actually go and incorporate this whole thing that broke out. So we'll go all the way out to here. So you can see that this is kind of that opening range. And so you can see the opening range is actually in a little bit of a downtrend like that. This market had a wild, crazy return. Is it going to come back down into it and continue in that range? That's the question. Is it going to continue in that RAF move? But the more information we have, the more, obviously, the more you're going to get. Now, this kind of come in here. We can redraw that RAF. We can start from the opening bell, which was 7:30 right here. And then you move it out and see it's just gone nutso. So that doesn't make a whole lot of sense to kind of anticipate that type of a rise in the market. So we will go back and take a little bit more data into consideration back to those highs. And we're still taking that move into consideration, so it's still in there. What do you think of that idea, Kirk? Kind of gives you a little bit of an idea of where the range was beforehand. You can go back farther. We actually have an article on this in Pitt News Magazine. I think it was in this month's issue, right? where we talked about this tool right here and how far back and how much is too much data, how much is not enough data. Of course, this is a 5-minute chart. We could go to a smaller time frame chart, but that's kind of our line right there. So if Kirk's idea works out, we would say that the market would be somewhere inside of this standard deviation, right? So going off the opening range, that's a good idea, Kirk. I like that idea. All right. So you were 3 or 4 strikes away. So let's see. He says 5535 at the money. CNP bought 3 days till expiration, 550, 550 call, and the 550, 520 put. Let me see where we did it on the Classroom. So on the Classroom, we did the we sold the calls at the money. So we're the same ones as you, right? 5535s. Yep, 5535. So we sold the same calls. You bought the 555.50 and I on the call, and I bought the 55.45. So you're one further out, and 55.20 on the put, and we bought 55.30 on the put. So we were one further out. 55. You did 55.20 on the put. So you were one further out on both sides than we were. So you did go just a little bit further. I think we did 2. This is two strikes out on the call and 1 strike out on the put. So you went 2 strikes out on the put, and you went 3 strikes out on the call. So you went just a little bit further out, so your premium was less. So I paid on this model yesterday, I paid $562.50 and $687.50. So Kirk paid a little bit less than that because he was a little bit further out, probably 50, 60 bucks less than that on each one. So maybe 500 and maybe 610 or something on that one. That's what I'm betting. So let's say Kirk paid about $1,000. I paid about $1,100 for my premium on that. Now, Kirk, did you go? You said you did go 3 days. Now you closed yours out at the end of the day. What was the premium decay on your bought options? How much did you lose? How much do you have to pay in premium decay on those? Because that thing closed dead center. So how much did you have to give back on the premium decay of your insurance premium, buy call and your buy put against your? So did you collect full premium? Did you wait clear till expiration? Did you collect full premium on your sold call and sold put? Kirk saying 55 at the money, call put bought 355, C 55.20. Yeah, just wondering if Kirk wants to tell us. He's trying to still probably in there trying to figure it out himself. All right, let me show you what happened to mine. All right, because I did not close out my insurance policies at the end of the day. I meant to, but I got busy, and so when I came back, so collected the full premium on the ones you sold. How much did you have to give back on the ones that you bought? That's the question I'm trying to figure out, because I held mine over the weekend. And I put limit orders in to take it off with $100 off. I was willing to give up. You don't always get what you want, but I wanted to give up only $100 on each one. So I paid $562 and $687. I collected $1,000. I wanted to give up $100 on each one. So I set a limit order to take it off at $100 on each one. So I lose $200 against my $1,000. So I'd have made $800 profit on that one, which sounds like that's basically what you did too. So your total profit ended up being $205. So how much did you have to give back on your put and call? One lot equals $205. So you made $205 on yours? Because I had to give up $100 on each. Actually, let's pull it up. I got it right here. This is what, now I don't know on the demo account. I don't know because I wasn't paying any attention to the demo account because I was trading the real money account. That was all combined 4-leg strategy. So when you bailed out at the end of the day, you had a $205 profit. That's cool. All right. I think you'd have done actually better in the real money account. Sometimes I think the demo kind of screws us. Sometimes I think it actually gives you more than you're supposed to. But this is what happened in the real money account. So at the end of the day, I lost. Well, they gave me my position on Sunday night. So Sunday, I sat here. When the bell opened, bang, the bell opened on Sunday night. I had my long position because the market actually closed down on Friday. So they gave me a long position, and as soon as the market was open, actually it gave me the long position, and then in after hours it turned and traded up. So I was actually up $90, and it actually went up to $165 and then flushed right back down. And I said, well, if it's going to flush out, I don't care. So it was Sunday night. I wanted to just get out. So I had my position that they gave me, right? Because I sold a call and I sold a put. And at the time of liquidation, they gave me my full premium. So I took the full, almost, let's say $800. I think it was $900 and $900 or something. That's something. Well, it's right there. Where was our numbers? Back to this one. The full premium that we received. Now mine was just a little bit different because this was what we did during class. And then as soon as class was over, I went in and put it on, but it was almost exactly the same. So we collected 5 and 3. So 5, 6, 7, 8, 9, about $900. All right. So I think all in all, when the whole program ended for me, I ended up like $800 on my real money account. So here's this morning I put on a limit order. Actually, I put the limit. I took the position off at a $97 profit Sunday night. So they gave me the position, and I wasn't around to close it out as soon as they gave it to me on Friday. Usually that's what I like to do, but I was in a business meeting and I couldn't get out, so I just let it go. And so on Sunday night, I was waiting for it to see what happened, and it popped up. It went $165. I dropped a stop in there. I said, if it turns around and comes back down, I'll just get out. And if it continues to run, I'll just let it go all weekend if it wants to. But it turned around, popped me out at 97.59. So I closed out 97.59. And then I still had the bot call and the bot put. So I still had my straddle put on there, or my strangle. Yeah, I still had my strangle put on there, and it wasn't going to expire until today. So it was today's expiration. So I put a limit order on there, and I said, take it off if you can get me close to $100 each. I'll lose $100 on each side. And it actually took me off when it had 389 loser on the call, on the bot call, and bot put at $182. So that's my $200 minus my 97.59 gives me 105. So I lost $105 on this one against my $900 profit. So I ended up with an $800 profit minus, well, this has commissions and fees involved. So I ended up with my wild eye, iron, crazy eye, iron butterfly that I put on Friday in my real money account made me $800. All right. So Kirk, I think that if you did that in the real money account, that's obviously your real money numbers. And I don't know if you did it in the demo account, you probably made way more money than the demo account showed you. But if you closed it out because of the implied volatility on the call and put at the end of the day on Friday, and they took that much money away from you, that's interesting. Because mine showed down quite, in my real money account, it showed down quite a bit on Friday too. And I was a little bit worried about it. I thought I was going to lose $400, and I actually only lost $200, but that's where I set it. So anyway, that's how it turned out. That's how the bread's made. So mine was $800 in the real money account. And that's what I lost afterwards. So that was that one. And then this was the real money account closeout at the end of the day, down 105. All right. So do we want to put another wild eye, crazy eye, iron butterfly on today? We look at the news. Right? We look at the news. There's no news. We got Fed speaking and Waller speaking. Dallas Fed, that came in at 8:30. It's kind of funny those are out of order. 1 a.m. and 12 p.m. are in the afternoons. We had such a strong morning. I don't know what we're going to do here. Got nothing else going on. Just those two guys pontificating. I don't think they're going to do a whole lot. If that would come down, well, now it came down and touched. This is the 5-minute. Let's go to the 15-minute on the S&P. There's our, see, that was the cone of probability for Friday. Look at that, guys. That's where that thing ended up. Dead center. Almost could not have been any more dead center. So that's why we got max profit on that one. That's why we got max profit. So holding that, not Kirk, it was Bruce. Bruce and I were having the conversation about whether we should hold that those wings over the weekend. And my initial thought was, no, don't hold your wings over the weekend because you're going to have just 2 more days of time decay. But we actually tried to collect on that time decay once. Remember where we tried to sell options at the end of the day on Friday to see what we'd get on Monday, and we got nothing. They gave us nothing. They didn't let those things decay for us over the weekend at all. And so in the thought of saying, well, if we're not worried about decay over the weekend, and Kirk, if you took your wings off on Friday, close of business, and they took that much money away from you, that's my concern, is because they pump up the premium on those bought calls and bought puts to go over the weekend so that they don't decay over the weekend and lose anything, because they're the ones on the other side. Because you buy them, that means somebody's got to sell them to you. And 90% of the people who are selling premium in here are not retail traders. Retail traders, for the most part, don't sell premium. It's the institutions that are selling the premium, selling the options to the retail traders who buy the options. And so they pump the price up so that they don't have to lose money over the weekend. That's why that theta decay is so small over the weekend. And on Monday, that's why I was able to get out with only a $200 theta decay all the way from Friday morning until Monday morning. And I only had $200 in theta decay. Because also you get in the morning session, and I didn't even look to see what time it closed out. Let's look and see what time it closed out. Does it have the times on my timestamp? It does. So it closed those out at 9:37 a.m. on 6/21. When's 6/21? That's showing, that's when I went in. When did it take it out? The 23rd. Oh, so it took it out yesterday at 7:16 p.m. Oh, look at that. Because I put my limit order in there. The market, see, because I took this one off at 4:07. So I took that one off at 4:07. And then I put the limit order on to just take the thing off when it lost $200, because it was showing that I was down like $400. And I was like, well, there'll be some implied volatility that'll come in and it'll push that market back up in price. If not, I'm going to end up holding a straddle all through today's market, which I was okay with doing too. So I just put it on there and said, well, if it gets to the point where it loses $100 on each one from my original premium, take it off. And it took it off yesterday, Sunday evening at 7:16 p.m. So I was trading at 4, 5, 6, 7. So only 3 hours later, it got a burst of implied volatility. The market started to move a little bit, widened that thing out, and it took them off. So I made it good till canceled. It would have stayed in there all day, all night long, but it took them off yesterday at 7:16, and I didn't even know it. I didn't know it until this morning, until I got up and came in here. I didn't bother to go look. I was just like, well, it'll probably still be on this morning, and I'll have to ride it through the morning bell. And maybe in the morning bell, I thought maybe I'll get enough implied volatility to widen that thing out that'll take my orders off. And it took them off last night at 7:16 for $200 loss, which was fine. Was very acceptable to me, because it was my insurance policy protecting my $800 or $900 win. Yeah, that turned out good. That was, I don't think you could have asked for any better. This is a classic setup. This turned out better than I could have ever hoped. So I got full profit on this thing. Paid $100 for each one, and it closed right in the middle. I guess hindsight's always 2020. Could have looked back and said, if we would have done Delta 20s. So let's go look at that. So if we'd have done Delta 20s, this market's still taking off to the moon. Look at that thing, stayed in that cone of probability the whole night long. See, that's why I was able to cash out at full profit. And I don't know, you say, well, Len, you lost $200. Yeah, well, okay. Hindsight's 2020. If we would have done Delta 20s instead of the the 3-day, if we'd have done Delta 20s with the same days of expiration, we'd have probably only had to pay $40, $50, maybe $100 in premium instead of $200. But then we wouldn't have had any protection. When you do Delta 20s, you've got almost no protection against the market moving outside your cone of Delta cone. That's why you see these guys on these other channels who are scared to death when the market gets close to the outside of their cone of probability, because that's where they start to be in negative territory, right? And they have no protection, because they do those really wide Delta 20s, or some guys I've seen them doing the Delta 10s, and they're doing the same day expiration. So they don't even have any overnight theta protection. So, but if we would have done that, we'd have probably actually made more money today, this one, because in this one, the market closed right dead center of where it was. But you know what? Most of those guys would have exited. They'd have exited. They got in right here. And then when this market took off and left the cone of probability, they'd have all got out right there with losses. That's how they'd have done it. Those guys in those other channels. And it's not, I don't want to keep saying we're perfect, because we've been trading. I've traded them like that for years. That's how they're taught. That's how you learn them. So, I mean, this channel, we've traded them like that forever. And I've traded 10 in a row and won all but 2. I think I did a video on it on YouTube. If you go back and look at my channel, you'll see where I traded iron condors and iron butterflies like that, and just did 10, 12 of them in a row or something in one video, and won all of them but 2. The problem is that when you do that, the 2 that you lose on loses all the profit from the other 9. And so that's kind of a really hard strategy to trade. It's really cool when you make money 10 times in a row and you're like, man, I'm on top of the world. And then you do the exact same strategy and you lose once, and 50% of everything you've made in the last 5 trades, you have to give back. And then you do again, and it loses the second time in a row. And then now you're out of 12 trades, you're losing money. That's a problem with that strategy. And that's what we've been trying to solve here in this class, right? We've been saying we can't do that. And that's why, when we did that study and we found out, well, 66% of the time, the market leaves our cone of probability. So we have to have a hedge. You can't trade this strategy successfully over a longer period of time without a hedge. You got to have the hedge. And if you don't have it, if you're sitting there working on a wimpy hedge, you have to do what those guys are doing, which is jump out of the market every time it approaches a break even in the very early stages of your cone of delta probability. That's why this is such a hard strategy to trade over a long period of time. if you're going to do that Delta 20 and not have a better hedge. That's why we've got to work on better hedge. And I know the better hedge costs more money, but in the long run, it doesn't cost more money because when you need it, you got to have it there. It's got to be there. Yeah, there's Kirk saying he's had the same experience as I have. Says I don't like the ICs. Because of the 10R loss wipes out 10 each 1R win. Yeah, that's exactly right. I'm not getting all of your abbreviations, but I know what you're saying. You have 10 wins and you have one loss, and the one loss wipes out all the profits from the 10 wins. That's a tough strategy. And that's primarily what an iron butterfly is. I mean, that's kind of what it is. An iron condor is the same way. You have one loser and it wipes out all the profits from your 10 wins. So that's why I've been trying to figure this out and working so hard with you guys in this class to try and solve that problem and have better hedging. Now we can do it with, I think we can do hedging in the Pit News magazine for this month in the July issue. Again, I've got 5 different versions with different hedging strategies, and you can pick any of them. It's like, Lan, which one's the best? I actually say this in the magazine. The first question that's going to come up is people are going to say, well, which one of these hedging strategies is the best? Well, the problem is you never know until after the market closes which one was the best, right? I mean, this time we could have said, well, the Delta 20 would have been better than the one I did because it closed dead center of our Kona probability, and my premium would have been less, and I'd have lost less money than $100 on each side. I could have lost probably $50 on each side, or $100 on each side, or lost 100 total instead of 200 total. But then I didn't have any insurance policy to speak of if the market took off and ran in my favor or ran against me. And so to me, spending the extra couple $100 to have that protection in case that market takes off and runs, I think it's worth it. And so I say that in Pit News magazine this month in the July issue. I talk about that. I said, people are going to say, well, which one of these is best, Lan? You got 5 different versions here. I think the best one is the one that you can feel most comfortable executing and running with, the one you like the best. Which one, feels best for you at the time, and which one, because some of them are kind of hard to execute, a little bit more difficult. Some of them require some movement through the day. And there's nothing wrong with taking them off at midday too and not running the whole thing to the end of the day. There's nothing wrong with saying, hey, we're just going to take them off at 25% and that's it. We're done. Because that happens more often than not. We could take them off at 25%. But then half the time you feel like you left money on the table. That's the problem with taking them off at 25%. So if we can leave them on all day long until expiration, get our full premium, because you're going to collect full premium no matter what, right? You sell options, you let them go to expiration, they have to give you the full premium that you sold them for. So that's the name of this game. So you're like, what? You don't lose any money? No, that's not how it works. When you sell premium, when you sell your option and you sell it like in this one here, see this? When you sell it, see that? We sold them for cost basis -480, -450. They have to give you at expiration, they will give you 480 and 450. That'll be bam, right in your account. That's what it'll show at the end of the day. You have it. It goes right into the bottom line for 480 and 450. Kirk's over here saying selling premium is the cat's meow. He loves it. I do too. I think it's really great. This 0 days till expiration, selling 0 days till expiration premium, this is really cool. We haven't had this very long. I mean, usually you only had them on Fridays, but now we have them every single day. You had to wait till a Friday to do a 0 days till expiration because we didn't have the weekly expirations, right? Now we do. So a lot of more people are getting into these selling premium, but it still takes some savvy traders to be able to do it. What we've been doing here, sometimes I think people come and watch our videos and they leave because they're like, man, that guy's way over my head. I don't know what the heck he's talking about. But you guys have been following along. You've been coming along with me, and we've been going through this process. So, we drop a few people off when we start talking about options and selling premium because it just gets way too complicated for some people. But it's worth it. I think it's worth taking the time, the effort, and energy to learn it and dig into it and run some of these studies and tests and follow through. And I think it's worth it. I mean, we all love day trading. We all love going in and dropping orders in and, scalping a little bit of money here and there using our scalp and trail strategy and automated trading system stuff. That's all really fun. We like doing that. But it's effort, it's energy, and it's high stress, and it's, concentration, and you have to sit there and you have to be so good, and the market has to be so right. And there's all the things that have to come together to scalp and day trade. When you're selling premium of options, all you have to do is just have a dead market. And then you make money. It's like you just don't have to do anything. You turn it on and walk away. Come back in 6 hours and see if you made $800. So that's what's kind of nice about it. You just need dead markets. So the market takes off and runs. That's where you kind of get hurt, but that's where you need to have better insurance policies and have your hedges on, because it's really hard to predict whether a market's going to be busy or not. And that's the whole name of the game. But you're going to collect that whole premium right there. See, so 525 and 387, that's your money. You get it no matter what if you let it run all the way till expiration. The question is, one of these, if the market goes away from your profit, you're going to get exercised on one, and they're going to give you a position. And then the position is always going to be against you. So depending on how far out of the money that position went is how much money you have to give them back. It's the loss on the trade. So that's what happens at the end of the day. I think I have a picture of that last time we did the real money. What they do is they give you the premium, and they also give you a position. So now you have a contract in the market in the wrong direction and where you're losing money. So you can trade that contract out, which is what I did, right? I did that yesterday and traded that contract out. And that's where I ended up. The contract they give you, they're always going to give you one contract, and it's going to be the one that's against your favor, losing money. But for me, it turned around and started going in the money. So I ended up making $97 on the contract they gave me. And then I had to liquidate my premium and liquidate my call and put, and I took them off without letting them run the rest of the day. I could have let them run today. They'd have probably made money. I'd probably been, if I'd have put it at 0 and then let it run through this morning's market, the implied volatility today, because the market ran so hard on the break open, I bet I could have taken them off at 0 or maybe even $100 profit, but I didn't want to take the risk. I didn't know what the market was going to do. So I took them off at $100 profit, which was fine with me. Took my $900 down to $700. So I made $700 on this wild eye, crazy eye, iron butterfly over the Friday and over the weekend. So that's how they do it. They just give you the full premium of what you sold them for, and then they give you a position against the sold spot, right where you got in, right where you sold them, that line, you have a position. So let's come in here and look at the example of today. Let's say we come in here and that's a 5 minute right there. And we're right back at the dead center of the cone, right? So where the market started this morning. So let's come in here and let's see what we could do one on. Let's say if we're going to do one today, we're going to go 0 days till expiration. And we need to sell our premium first. If we want to put them on the same ticket, we don't need to sell the premium first. But if we're going to put them on different tickets and liquidate throughout the day, then we need to put them on different tickets. But we can put them on the same ticket. We do the same thing we did on Friday. We can come in here. We're just going to sell the 2 centers. So how much is that? You're going to get that no matter what. 423, 485, 809, let's say $900. Same as we did on Friday. It almost comes out to be the same every single day. So $900. That's yours. Boom. $900 cash on the barrelhead. That's yours no matter what. You get it. All right, when you sell those. Now, the problem is they're going to give you a position against those right at that location, either good or bad. So if the market rallies, they're going to give you a short position. And if the market falls, they're going to give you a long position from that red line. So if the market rallies, you say, well, if it rallies, it can go up because they're going to give me $1,000 or $900. It can go up $900. Well, if you go up $900, there's your $900. There's your break even. That's where you start losing money because they're going to give you $900. And then if they give you a position from that red line, if the market goes up, they're going to give you a short position and you're going to be losing $900. So that's your break even. So you can just draw a line in there, right? Just come in here and it's about $900 on both sides. So we'll just draw a channel. So that becomes your break even right there. Anything outside of that, if that market leaves that channel, and that's why we take our RAF, and our RAF ends up saying that market's in a bullish trend. But let's go back and how much data you're going to take into consideration. Go back to the beginning of the day. If I can grab the handle. Can't grab the handle. There we go. Start right there. 12 o'clock a.m. So there's your RAF. And look how the RAF says that market's going right straight through the center. But that's because of all night long. But it's taking this move in the middle. So there you go. If it stays inside that outer box, that $1,000 box, that's where you make, that's your break even. You'll make nothing right there. But now you have to buy some insurance. So if you sell that, you have to buy some insurance. Well, how much are you going to pay for your insurance? Well, if we just do 0 days till expiration and we buy insurance here, we buy a call and we could buy a put right here. See, look at how much our insurance is. $285, $388 against our $900. So we've got $300, $400, $500, $600, $700 against our $900, $800, $900. That's your $200 profit, and that's probably where Kirk came in. That's why Kirk had a $200 profit. But if you go out a little bit further, your insurance premiums don't have to start covering you until this outer line, right? But you have to also cover the cost of the insurance. And that's where we start running into problems with this strategy. Is because now we're going to pay $215 insurance, $266 insurance. We're going to collect $1,000, but we also have to pay however far the market leaves, and we have to pay for that insurance. So we have to pay for the insurance, $215, $263. So we're going to pay $470 for the insurance. We're going to make $900, but then the market's going to move the distance. So we have to add another. So we take our dollar calculator, the distance between where we're going to have our premium and where they're going to start the insurance, that's $500. So now we have to add the 271 and the 215. That's 5 plus the 500 that you're going to lose if the market's outside that box. It's more money than you collected. You're going to lose money. See that? See how that works? That's why we can't pay that much money in insurance. Because at the end of the day, you're going to pay that entire $233 for those puts and calls. You're going to lose your entire premium because it's a 0 days till expiration too. So that's why that strategy doesn't work. And unless that market stays right inside of that little cone right there, if it doesn't stay inside that little channel right here the whole day, that's where people get scared and they bail out because they're going to lose more money. It's got to stay inside of that. If it stays inside that little red box, then they're happy and they're like, okay, I can make some money. But as soon as it breaks out of that box, yeah, absolutely. Kirk's right. Hitting singles is okay. But in this scenario that I've got on the screen right now, that's not even a single. That's $100 loss. If it leaves that red box, I'd lose $100 because I'm going to pay more money in premium for the insurance, and I'm going to lose $500 on the exercise of my option at the end of the day if it's outside that box. So I would actually lose $100. That'd be a $100 losing trade right there, and that's what I'm trying to solve the problem on. That's why I start playing the theta swap, and I put theta out to the next day out because we have that decay in our option, right? So we have that option decay, and you've seen me show this sheet a million times. Where's our options? Right here. So we have, let's go to this one. Well, let's go to this one. So you have a 2 days of option. See, in the beginning of the option, we don't lose very much theta. We don't lose very much money on our bought calls and puts. But towards the end, man, you lose it really fast. So you could do this, Kirk. I think that this would be safe to say you could do it if you're going to pull it off at 25% and you're not going to lose that much on the loss of your premium if you're going to save those just for a single day. But see, you're sacrificing at the end of the day on this one, we got $278 of premium and $177 in premium that we're going to have to lose at the end of the day. That's $300, $470. Now I paid on the one I did on Friday because I had to hold it over the weekend. I paid what was the insurance on that over the weekend? It was a lot. It was expensive. But I only lost $200 of it. Whereas this one, I'm going to lose $300, $400, $500. I'm going to lose $500 on that one. Whereas on the one where I put that expiration out, oh, that's the wrong one. I put the expiration out. See how much I had to pay for that insurance? Buy a call with 3 days till expiration. I paid $562 and $687. So in this case, you can see we're paying $160, $250, and $306, so $470, nearly $500 in insurance. But over here, I paid twice that, double that. The difference is that I lost $200, a very small percentage of it compared to what I would lose over here, which would be the full $500. So it saved me $300 by buying it further out. I had to pay more money for it, but I lost less. Due to the theta decay being smaller, right? Because at the beginning, the theta doesn't decay as much. But towards the end, the theta drops off really fast. So by buying a 3-day option, my theta decay was only $200 instead of losing the entire $500 by doing only a single day. By pushing that theta out into the future farther, you still have pretty good insurance because it's still going to be sensitive to the movement of the market, but it's not going to decay as fast on your theta. So that's why I've decided that that's a better strategy. I've been having a lot better luck doing that. The question was, and that's the question that that Bruce and I were having, was whether we should do it over the weekend or not. And it seemed to be, Bruce, it seemed to be okay. It turned out good to do it over the weekend. In fact, it turned out fantastic because it actually closed it out on Sunday afternoon. Didn't even have to go all the way into Monday. So, all right, guys, these are all discussed in Pit News Magazine. All these different strategies, all the different stuff, all the different scenarios. Again, I think there's like 6 scenarios in there. Plus, there's some really fun ones called a delta. The delta, I know we haven't actually done that one, but I talked about it, where you do the dollar cost averaging and you actually move the cone of probability as opposed to instead of hedging your position, we move the cone of probability through the purchase of underlying contracts. And we do that with micro minis. So you pull up the mini and the micro mini, and as the market moves against you, you dollar cost average out and it moves your cone of probability. It's kind of a neat strategy too. It's a little bit more sophisticated, a little bit more difficult to manage. But I've got that one documented in there so you can try it and play with it in Pit News Magazine. That'll be in the July issue. So, all right, guys, should we put this on? This market's being a little bit crazy right now. Wouldn't want to put it on right now. I haven't put this on. Those are just laying in there. I haven't sent them to market. So let's see. What do we want to do? Do we want to put this thing on? We want to move it probably if we did. Well, I don't know. It might come right back to it's kind of a weird place to put it on. We kind of missed our opportunity to put it on. We should put it on right there because it'll probably end up, kind of like Kirk said, it'll probably stay within that, stay inside of that morning session bell. It'll probably stay inside that box right there. That's a good little trick, Kirk. I like that one. We're going to have to remember that one. First 15 minutes, though, would have been a little bit smaller. But this big rally here, it'll probably stay inside that big rally at the end of the day. Let's draw that in there. And if that's the case, if it stays inside this box, where do we want to put it on? We want to put it on down here a little bit. It's up a little high for us. But we could skew it with the delta skew. I mean, we could do the put skew. Let's clear these out and put it on again. Let's come in here. We'll go sell, sell. I think if I put my real money one on, I'll wait for it to come back to the center, which it's almost there now. And so now we're going to go out a couple. We don't have to. See, this is the Kirk's saying the traditional opening range is the first hour. Yeah. We could go off the first hour, which is what this is. This is the first hour. And that's probably the problem with that, Kirk, is that we lose a lot of our implied volatility by waiting. And that's been part of the problem with me doing my real monies after the class, because I'll sit here and we'll watch them, and then the implied volatility drops way down, and then I go put them on afterwards. And it's not been that big of a deal, but I know a lot of guys, one of the things they like to do is they'll wait until the opening bell, the very first second. And the minute the opening bell comes in, they hit it and they sell them at that point, because the implied volatility is at its max at that point. And so these things are really super inflated in price. And then just the implied volatility, what we call the the volatility crush, an hour later, boom, you're going to lose that big in volatility crush, and it's going to be really difficult for the market to move against that implied volatility crush. That's why I like to set my limit orders to take the profits off as it goes into the morning bell from the previous day's insurance premium, because when it hits that volatility crush, those options that I bought will significantly increase in value as well, because it's the other side of the trade for the guys who are selling them, right? And so that's how that market will pop out like that, and I can sell them and not lose any money. In fact, today, if I wouldn't have sold them with $100 worth, I put my limit order on there to take them off at $100 on Sunday, I could have probably left those on all night at zero. And when we hit this volatility pop here this morning, they'd have probably paid off and I wouldn't have lost anything. That's my bet. I'll bet you I could have sold those things that I had bought last Friday morning. I could have probably sold them for zero loss if I would have let them go into the morning session. But I didn't. I was just happy to get out with the $200 at the time last night on Sunday night. I was just like, well, if I can just get them off, I made $900. If I can get off with $700, I'll be happy with that. That's a nice little chunk of money. But with this volatility run, I'm sure I would have gone to zero loss. I could have got my entire premium back. So that's what I'm thinking. So a lot of guys, rather than waiting for the hour to go by and then have that volatility slow way down, they do it right on the open and they catch that volatility crush. And that's how they make their money. They'll, a couple $100 later, an hour later, they made $200 or $300 and they're done. That's all they do. Of course, then they do, 10 of them. You made $3,000. So my rule is to trade a 3 lot and to close out 3 if you are down 20%, close 1 if you're up 20%, close out the second and say 40%. Let's let the last one run. That's a good idea. I like that too. That's a good idea. We're just trading onesies right now. Just trading onesies. But that's a good idea. Once we get to the point where we feel comfortable doing more than one at a time, we can do 3 of them and close them out at different points, different levels across. That's a good idea. Very, very good idea, Kirk. I like it. All right. Are we going to put this on or not, Lan? Are you going to put it on or not? Let's move now. We go 2 strikes out. We could buy this one. Oh, now it's moved back down. There we go. That's where we want it. Back down here anyway. Oh, it keeps jumping around. Let's wait for a second. What's it going to do? Let's go to the traditional view. So we sell this one. We're going to sell this one. We're going to buy this one. We're going to buy this one. No, we're not. Yeah, we could do this. But what we're going to do is we're going to come in here. One of them, the ones we're going to buy. I'm going to open this up more. I'm going to get my window bigger. The ones we're buying, we need to switch. Buy to open, buy to open. So we need to change these to 1 day and 1 day. So those expire tomorrow. Oh, look, we can move it down again. Here, here. It means I want to bring this one down here and this one down here. I want to put skew. Do we think this thing's going to skew to the downside? Pay 117. Pay 250 if we skew it to the downside. Let's just go with that. So we got 1 day on our wings, and we've got 0 days on our sold. So we're going to pay $142. So 285. If we're doing this real money, we'd put it right at 275 and see if we could get it. It keeps moving on us. 280. Place the order. It's not going to do it in the demo. Oh, it did. It filled it. All right. There's our wild eye, crazy eye, iron butterfly. There we go, guys. So if we come into our positions, what did we do? We're collecting 455 and 300. It's almost identical to what we did on Friday. 4, 5, 6, 7, almost, well, $100 less, $800. So $800 is what we're collecting. And we just also bought a expiring tomorrow after market closed straddle. Actually, it's a strangle. And we paid 500, 6, 7. We paid $950 for it. All right. So we paid $950 for our strangle, but we're receiving almost $800 for our straddle. So that's called the straddle strangle theta swap. And that's what those guys have been copying us and talking about on those other channels. This little strategy right here. All right, that's it. Do I have a Sunday school lesson for you today before we let you go? We certainly do. But before you do, let's make sure that we like and subscribe. If you guys like what's going on here, subscribe so you get notified when we do it. Tomorrow, we're going to be in the afternoon, right? Tomorrow is Scalp and Trail. We're going to do Scalp and Trail on the Power Hour. So Power Hour tomorrow. And if you like today, give me some thumbs up so we can know that this is the kind of thing you like to see. So thumbs up, and then tomorrow is Power Hour. And actually tomorrow, Power Hour, I'll be able to tell you what happened to this option strategy, see if it paid off today. All right. And here is our Sunday school lesson. So our Sunday school lesson for today is plan your trade, trade your plan. If the market does not decisively move in your favor, get out. If you're wrong, admit it. Break out or bail out. All right. If you get stopped out, it's probably not a trade you want to be in anyway. So quit jumping in and out of the market. If you get stopped out, it's probably not a trade you want to be in anyway. I want you guys to say that every night before you go to bed. You lay your head down on the pillow and you say, if I got stopped out, it probably wasn't a trade I wanted to get in anyway. Now, I know sometimes you get stopped out and have the market take off and move in your favor, go against you, and it makes a big run. But that's less often than not. All right. So once you've moved stop to break even, relax, scale some positions out, build your reserve, then let the system and mathematics work their magic. If you want to stay in longer than what we do here, sometimes I just get in and trail up on the yellow dots until exit. That's scalp and scalp is really what we're doing. I mean, we call it scalp and trail because we're trailing, trying to catch those trends, but we're not really catching long trends. We're not catching day trades. We're not day trading in here. We're really just scalping. A day trade would be that you try and stay in all day long in your position. So once you get into a position, you try and stay in it all day long. Now, it's easier to do that with options. If you think that the market is going to run and go bullish all day, why would you do it with a contract? Just buy a call option and walk away. We could do that. In fact, we ought to probably practice that and show and see what happens. I'll do some testing, But, we do our technical analysis and we're in an uptrend. We look at a longer term chart and we think, hey, this market's just bullish. It's been bullish for the last 3 days. We're going to probably get another 2-3 days of bullish runs. Why not just buy a call option on the opening of the bell and walk away? You can do that. That would be more of a day trade with a 0 days till expiration. It's just going to see how far it's at the end of the day. It's got to go further than the premium you paid for it. And right now we're paying about $300-400 for premium. And you think about it, if you get stopped out 3 times, you've lost $300. Usually we'll risk about $50. So you'd have to get stopped out 6 times to lose $300. But how often have you day traded and ended up down more than $300, $400? Happens all the time, right? We're like, oh shit, I'm down $500. I'm down $1,000 today. I'm day trading. Well, that's because you got stopped out. And each time you got stopped out, you gave up $50, $75, $100, right? Well, if a call option only costs you $400, and that's the max amount of money you can lose, and you're willing to give up $300, $400, $500 on day trading, right? Anyway, buy yourself a call option at the opening bell. If you think the market's going to be bullish today, buy a put option if you think it's going to be bearish, and just ride that thing out at the end of the day and see how much money you make. Nothing wrong with that. You can certainly do that. All right. So once you've moved out, scale out, break even, relax. Let the market run. Take profits along the way. Pay yourself for a job well done. That's what Kirk was talking about. He's like, when he puts on these iron condors, he'll put on iron butterflies. He'll put on 3 of them and then take them out throughout the day. Pay yourself along the way. If you're starting to trade multiple contracts, right? We do that. That's called the king tut. That's what we call the king tut when we're doing it with contracts, right? We'll get in with 3 or 4, and then we start peeling them off as the market moves in our favor, taking profits along the way. All right. So Kirk's saying he does that with options. Absolutely. It's a great way to do it. All right, guys, I'm going to let you go. We will see you tomorrow for Power Hour.